Let's examine the fundamentals of the market. Let's see what is happening there right now. Firstly, we've got low interest rates. They're as low as they've been. A low cash rate, and that's moved forward to a low interest rate, both variable and fixed. Whether they drop any further, we don't know. To date, we've followed the likes of Bill Evans out of Westpac, and he was saying there potentially were more drops this year. After the inflation figures that came out last week, it's probably unlikely now we'll see another rate cut. But in saying that, who knows? We have an acute shortage of housing. Okay, that's paramount. So we've got a low cost to hold our asset, and we've got a shortage of the asset. We're not going to see any price growth if we can build the houses that we need. Okay, if we can build 400,000 homes next year, then we won't have a shortage of housing. We won't see any price growth. Can we build 400,000 houses? No, no chance. Developers can't get finance the way they used to. We have been developers in the past. We don't do it anymore, but in the past we developed townhouses, units, and I could go to ANZ Bank and ask for $6 million to build 25 townhouses, and they would say, no problem, there's the money, get on with it. Today, if I went to ANZ Bank and asked for $6 million, they would say, you're building 30 townhouses, no problem. Once you've sold 15, in fact, once you've sold 20, come and talk to us and we'll give you the money. They want all their debt exposure covered before they'll give you the money, which makes it very difficult for developers to actually produce the product we need. Hence, we've got a tightening rental market with investor yields increasing. So if I look at the property market, I've got a low cost to hold. I've got a shortage of housing. That's not going to be fixed in the near future, which means my yields are high. For me, that belies a very opportune time to get into the property market. However, we can't just assume we can buy anywhere and get fantastic results. We want to absolutely understand the characteristics that lead to capital growth through identification of the supply and demand imbalance. We start with population. How many people are going to be in the country next year? Combination of immigration and organic growth decrees about 380,000 people will be in Australia next year needing somewhere to live. Given that the average household size, the demographic change right now is reflecting 2 to 2.5 people per household, that's telling us we need about 180 to 185,000 houses built next year to actually deal with demand. In 2013, we've built about 130,000 homes, well short of what is required. We're very much focused on employment growth. We need to see employment in all the corridors we're entering. And we examine employment under different measures. We look at itinerant short-term employment, the pros and cons of that, and we also look at long-term stable employment. Firstly, if I examine itinerant employment, I look at areas which have had fast-moving markets. A lot of these have been mining areas, where if we look at Gladstone as an example, Gladstone has a base population of 27,000 people, but because of all the infrastructure works happening around that region right now due to the LNG gas works in the area, there's an extra 10,000 people thereabouts in that region. You put 10,000 people into a region, increasing the population by about 30%, it makes a significant impact on both rents and capital values. It puts pressure on the market, and that's what it's done. So right now, if you went into Gladstone, you'll be paying an absolute premium. The market is as hot as it's been. You'll get a good yield there, but you're also paying a lot for that yield. However, when those works, when the infrastructure is completed and those people leave town and the population drops back to 28, 29,000 people, get ready for the price to drop. Get ready for your yields to drop. So we have to be aware there is an opportunity with short-term itinerant employment, but there's also a risk. We prefer to look at the longer-term stable employment regions. If we look at Sydney as a market, we can look at the state government's plan. They've got a strategic plan on where they're going to locate employment, and it's largely based around transportation and infrastructure. And we'll see that Barry O'Farrell has plans for a 40,000 strong employment centre midway between where the M7 crosses the M4. Okay, so these are the kind of areas that we might focus on if we're looking just at the Sydney market. Wherever we go, we've got to understand affordability. Affordability will be in ratio to the earnings and the incomes of people in the areas they're at. As an example, in Sydney, property is $700,000 as an average. It's becoming unaffordable. The average income in Sydney is $70,000. So I think there is a genuine line in the sand being drawn between those that own property and those that won't ever own property. We prefer to focus on properties that are more affordable. So even in the Sydney market, we might focus on assets which cost $400,000 to $500,000. Particularly if we're looking at resale down the track, I want a large resale market. So if I'm buying in at $400,000 or $500,000, I know that I can sell it $650,000, and I'm still under the current median in Sydney, which means there will be a volume of buyers. Another issue which has impacted the demand for property has been government incentives. We saw this several years ago during the GFC when Rudd brought out the fiscal incentives, particularly the First Home Buyers Grant. And we saw buyers in New South Wales receiving up to $42,000 in incentives. So that would bring buyers out of the woodwork. So if you're going to get $42,000 tax-free from the government, yes, you're going to be focused. And so that improved the market in 2009 substantially. It also created a floor in pricing, so it increased the base cost of entry for the market. The first home owners grants have now been diluted and altered, and they're different state to state. We focus on them, but they're not as big an impact as they were back in 08 and 9. The Housing Affordability Fund was a fund set up again through the Rudd government during the GFC, and they put $500 million into a tin and said, okay, for areas which are becoming more unaffordable, we'll offer a rebate of $17,000 to $23,000 to any buyer of land in that area, so long as they build a house or build a house to rent or build a house to live in. Very few people found out about this. Our clients did, and 25 clients were able to get into properties paying no stamp duty and getting a $17,000 incentive from the government. It's still around today, albeit in areas where we don't believe is perhaps the most sound investment. In New South Wales right now, we get $5,000 for a new property. In South Australia, we get $23,000 for a new property. So it begets a question, do we buy in Adelaide because we're getting $23,000? Well, the fundamentals of the Adelaide market, for me, are soft. A lot of people were buying into South Australia on the basis that the Olympic Dam project was going ahead. When that pin was pulled, South Australia has taken a hit. So no, I wouldn't be rushing into that market, even with a $23,000 sweetener. The big one is the National Rental Affordability Scheme, an opportunity where investors will receive over $100,000 tax-free from the federal and state government when they buy a property with an incentive attached. It's going to get your attention. It does get your attention. Who's not going to look at a property that's going to give an extra $10,000 tax-free income every year over the next decade? All these incentives are simply that. They're incentives. If they're on a dud asset, it doesn't help the asset. So there's no point buying a property if you're blindfolded by this scheme. Let's get the property right first, and if we can overlay one of these schemes as well, that's where we can really get the great returns we want. This chart is showing the balance sheet of property. This is demand and supply. These figures are sourced from the ANZ Bank's Economics Department. And what they're saying is there's a gap between demand for property being the black line and the supply of property being the red line. This gap in in supply has been leading to the cumulative shortage in supply of housing going up and up and up. And according to ANZ Bank, by 2015, there could be a shortage of 600,000 properties. That significant amount of shortage leads me to believe that the gap between those that own property and those that never own property is cemented at this point. We've read about it recently where Mum and Dad were buying their university student daughter her first house because she wouldn't be able to afford it. They spent $1 million at Surrey Hills for a terrace. I read about a 4-year-old boy. His father bought him a one-bedder in the city for $700,000 because otherwise he won't make it into the market. When you see figures like this, I would rather have property than not have property. We know that our yields will increase and so will our capital growth. On a state-by-state basis, we look at the supply and demand. And again, what we're seeing here is the blue column represents demand, green is supply, and the red is a cumulative shortage of supply in that state. Head and shoulders above any other state is New South Wales. The current shortage across New South Wales is 180,000 properties. The other issues, other states with issues, Queensland and WA. You can see South Australia is insignificant. And what's happened more recently in Victoria, we've seen more and more properties coming onto the market. So demand is now equaling supply, and their shortage has dropped. In the next 18 months, the figures are suggesting that as many as 24,000 apartments and properties are coming onto the market within 5 or 6 kilometres of the CBD of Melbourne. The Melbourne inner city market warrants a demand of 7,000 properties a year. If you've got 24,000 properties hitting that market, I can only imagine it could be some kind of bloodbath by 2015, 2016.